Love to see some feedback on the screen, and we can work from there. Well, welcome to the World Indices Strategy Update. I just must check that the sound is working for me. That looks all good. And if you can't hear me that well or can't see the screen, I'd love some feedback from you. So where are we going tonight? We're going to have a review of the markets, see where things are. Generally, it's been working pretty well to plan, according to clockwork. And here's the thing. This has been working to clockwork. We haven't really seen, we haven't seen a big fall in the US equities markets. That's probably a disappointment to most people. We're going to review the markets today, have a look at the European markets, have a look at the US markets and see what can happen. And we all know the leaves fall in fall, and so do stock markets. So I don't understand why people are surprised when the markets fall at this time of year, because that's what they do. So welcome to fall. So this information may contain general financial services advice which may not be suitable for you. It is not prepared for your specific investment objectives, financial situations, or needs. You should consult a licensed investment advisor before making investment decisions. Past performance is no guarantee of future performance, and there is a risk of loss in trading as well as a potential profit. There's a warning and disclaimer, and it is issued by Ideal Financial Group Proprietary Limited, a corporate authorised representative number 299753 of Aruda Proprietary Limited, AFSL 338674, and Adesk Trading Proprietary Limited. So can I get a little bit of feedback about how everybody's feeling? Are you bullish? Are you bearish? Where are you? Let me know where you are. Are you bullish or bearish or neutral? I'd love to know. And if you can let me know at your leisure. So, welcome to the forecast, an update for world stock markets and strategy update. So what have we seen? We've seen the US market topping, rolling, churning after making a top. Basically, that's it. We've seen the DAX sad, we've seen the FTSE sad, we've seen the Italian MIB confused, we've seen many things. We've found that China actually looks like US dollar index. What do I mean by that? Let's have a look at the US dollar index and do an overlay of the chart. US dollar index versus China. Look on a daily chart. We're going to do a comparison chart. And we're going to look at the SSE. That's the charting arrangement. Now look at this. This is the SSE. Now, is this an extraordinary thing? I don't know if anybody's noticed this. I certainly don't pay attention to what other people talk about, so I'm the worst one to probably the worst one to talk about these things. But you can see here, the purple line is the Shanghai stock market, and the red, the candlesticks is the US dollar index. So what can we expect if the US dollar index is, if the US dollar index pulls back, we can expect a potential change in trend for the Shanghai A-shares index and the Shanghai composite index as well. Just something to be aware of, and we can see today our friend the US dollar index has popped higher. Most things are running down or up because the US dollar index is running, and watch for that for a change in trend, and we'll talk about that a little bit later. So Hong Kong, that's been whacked. We see why. There's demonstrations. It's about China, and we've seen volatility doing good. So the volatility index and the VIX, I've been talking about target towards 18 in the VIX, and that does seem to be coming true at the moment. We've had good movements, and there is a theory that stock markets go down when the currencies go up, and the US dollar has been going up and the US stock market has been struggling. So let's have a look at that theory on a composite chart basis and just see what it looks like when we chart the dollar index over the currency itself. We can't see any difference, except that there doesn't seem to be a correlation. So that truism doesn't seem to be true at the moment with regard to the US stock market. What you can see is there is a clear relationship between the Shanghai A-shares index and the US dollar index. Does that make sense? I don't know. Let's have a look at the Nikkei, see what that's been doing. Yes, there's a bit of a correlation there. US dollar index versus the Nikkei. Nikkei, US dollar index goes up, Nikkei goes up. US dollar index goes sideways, Nikkei comes down a little bit. That's particularly since June. Had anybody noticed that until I pointed out? Let's have a look at the poll, and we can see that 25% of people are bullish, 50% are bearish, and 25% don't care. Now, as you're mainly Profit Hunter Group members, that is a little bit of a biased approach, because the 50% bearish would be probably following my little tune for a while. But 25% who say don't care, 25% who say bull. The actual thing that we see is 50-50. There's no strong bias either way, and there should be. So that's a curious thing when we see that. That really does make me wonder what's going on. Okay, so we have to think. A fair bit. Now today, I'm really not wanting to follow the normal format in a big way, but we'll go through here. Let's look at some technicals. This was a chart about a month ago, and I was saying this chart, the Dow Jones Industrial Index, was on a quarterly bar up the top end of struggle street. Now you'll notice the closing price 1 month ago was around the 17,098 area. It was, I think this was we did this on the 28th of August or thereabouts. You also may have noticed the correlation between me going on holidays and the markets topping or bottoming. I was on holidays in early August 2011 when the market decided to puke based on Standard & Poor's. In fact, I was pretty well ensconced in stuff that couldn't get me away. At the bottom in November, 2012 on the 16th. The retest on the E-mini, we were in the Cook Islands, and we were away in Asia at the end of September, October, or August, sorry, August, early September. Anyway, this is what that chart looks like right now. I'm not saying it's a Paris end of struggle street, and it's ugly below 16,320. Nothing has changed. As you can see, it is currently trading only 17 points. It closed lower than last time. It is still pretty well in the Paris end of struggle street. Nothing has changed yet. Let's look at, on the long-term basis, let's look at our favorite chart, Dow Jones Industrial Average. And the Dow Jones Industrial Average, and we'll get rid of the US dollar index here. The Dow Jones Industrial Average here is still in that sort of channel, still in that sort of trend, but you can see it's broken down a little bit. When you resolve to a monthly chart, you don't see a breakdown. No breakdown. It would need to be below 16,520 now. That would be the point at which you'd start to think that it has some serious problems. The one thing that we do notice is that the volume this month has been higher, so we want to see this close lower. Do I think this is going to happen? Probably not. We're starting to run out of time on the downside, as you'll see later over the next couple of weeks. We could come back down into these lower areas, 16,500, but the reality is it needs to break through the struggle street pattern. And when it does break, it will be hard, fast, and everyone will be surprised. But at the moment, this pattern on the US market still is not diabolically bad. What I would say is a break below 16,900 is your key. Anything below that, you start to think 16,500. The inability to hold above 16,700, 16,500 area is not a positive for the US stock market. But at the moment, we haven't got anything that tells us it's changing trend. And we're going to look at a few other things shortly soon. Let's look at the relationship between, as we have done in the past, we're going to have a look at the relationship between the spread between the Dow and the bonds. So we're going to create another chart here. And I'm on a different computer, and that's probably, so we're going to have a relationship between the Dow, and we're going to spread it by dividing it by the US 30-year bonds. And we can see here last time, this is on the, should be on the weekly charts, and we need to get rid of some of this stuff. You can see on the weekly charts, it's spent a lot of time up there. Last time I pointed out the fact that on the quarterly chart, it doesn't like hanging around this ratio of 130 to the Dow. That was back in 1999. Over here, 1999, top of the tech wreck. 2007, top of the market. And 2013, not quite the top of the market, but the bonds have rotated. So we're seeing this decline in interest in the strength of the Dow. The bonds are starting to win a bit of favour. We've seen some rallying backwards and forth. But eventually, the thing that hurts most stock markets is where bonds start to fall. And here we go. These are the notes. These are the US 30-year notes, but sorry, 10-year notes. And you can see all these lines, and I apologise for all that sort of stuff. But what you see is interest rates stop bull markets because they make corporate profitability harder. That's just as simple as that. So we have a stock market that we like to think is in a topping area. It's got a topping pattern, but it's not confirmed at all yet for a big. Now this is the forecast that I talked about, and we were talking about having a retest in early August, and then another movement across to the end of near the end of September, and the rest of the buying time coming out. Now the forecast that we saw has been shifted. It's not been working, obviously, largely because I think Janet Yellen and her friends have been, we're now around this period here. Janet Yellen and her friends have still maintained low interest rates while removing bond buying, if you like. So we don't have the same tops and bottoms, but we do have some cycles coming in. Now, when we look for the next one, we see the normal pattern in the Dow. This is a normal year. Is to top in mid-August and look to buy mid-September. We're going to look a little bit more look a little bit more into these babies and what is going on here. And I'm going to show you some biases in the markets and in different chart. So one moment. David Hunter. Good, thank you. We're in the middle of the webinar. Yep. Yep. No, Anthony, I'm actually just presenting at the moment. So can we go through the details tomorrow, maybe, or after? Yeah. Okay. Cheers. Bye. Apologies for that. So here's some trades you may not have thought about. Now, what's a Berkshire Hathaway share worth? Right now, it's worth about $207,321 US dollars. So that's about, say, 230,000 Aussie dollars. There is a trade coming up that you can take to buy Berkshire Hathaway on the 30th of October for a 6-month hold. Notice that chart. That chart shows that it still doesn't want to go down, and it's got support around the 203,838. So this stock market still hasn't died. We're going to phone a friend and have a look at some of the charts in a little while. But Berkshire Hathaway, as a collective of the whole stock market and the wonder kid, most loved person in the world of the investing public, people want to be him, women want to be with him, and he drinks cherry Coca-Cola or whatever he has. This has a bit of a cycle that likes to go. Notice it's bottomed here and it's had a little bit of a pullback. So you can be looking to buy at the end of October for a 6-month hold, or looking to buy couple of weeks before the end of December for a bit of a rally, or even better, look to buy in February. So Berkshire Hathaway might be something to look at if you've got a spare 200,000 to buy one share and go visit the Oracle of Omaha and go to the board meeting. Maybe they get so much buying. I don't know what time of year. Maybe the cycle's based on the fact that he does his meeting and all these people go and buy a share before they do the meeting, and they go and listen to him and eat chips and stuff or whatever they do. Another one is looking to buy Cisco, CSCO, for a buy at the end of October for a 3-month hold. There's a lot of things coming up at the end of October. Might be safer to consider buying then. Oh, and look here, the Dow. It becomes a buy last week of October for a 3-month hold. Adrian, I'm not sure what you're saying there, but I'll take it as it's important, but I can't get the gist of what you're saying. So, okay, so let's move on. Microsoft. Now look at this chart. Cisco's probably the weakest of the charts that we've seen so far. NASDAQ, oh, let's go back to Microsoft. Microsoft could come back down to 45 bucks, but notice here, Microsoft doing pretty well. And it's also coming up for a projected low for a rally for a couple of months as well. 1 month, 3 months, thereabouts. NASDAQ. Oh, I think I know what you meant. Yeah, okay, I got it. Chap on the phone. NASDAQ, what we see is the QQQs. They come up for a low. You guessed it, end of October. Same deal. Where do we pick it up? At the moment, it's down around support. Really, if it broke down, I would be considering it down around that 37.50 area. And there are a few other ones which we'll talk about later, and we'll talk about the Australian ones as well. So we've seen that in action. The Dow Transports, we see basically low for the year in mid-September going up. Now let's look at the Dow Transports. This is the monthly charts of the Dow Transports. What has changed in that? Nothing, 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 nothing. We've had a 1 month decline. Over here we had a 1 month decline. Over here we had a 1 month little flip, and a bit of sideways action. Really, it's still not changed trend on a longer term sense at all. So can we get too bearish here? It's going to have to take those big shifts lower. Basically, the normal cycles were inclined to US equities from late August. And the thing that we find is interest rates are still low. There is a bit of a panic and a little bit of a worry. Janet's still a socialist and she's still going to pump the money. It's going to be really interesting to see when somebody gets in who has a right-wing bent in control of the US and goes, this is not good for all of us, keeping us on welfare. But till that happens, the money pump's happening. Now, I'm going to read out these things here for the bullhorns and bear pause warnings. We have bullhorns warnings long-term on the Hang Seng, I believe. No, we don't. It's actually short-term bullhorns warnings on the Hang Seng. That's about it for the equities markets, really. There's nothing telling us that there is a S&P mid cap. There we go. Is on bullhorns for warnings there. mid-cap S&P. I think that's the 400. And really not a lot else. We need a change in the direction of the US dollar to give us a shift in equities markets. Now, the other thing that we've seen is that on the way up in the stock market, we're getting bear pause warnings of some 1,500, 1,600, 1,400 were high numbers. This time around, we're getting bull horns warnings of 1,402. And in the OEX optionable stocks, and in terms of bear pause warnings, we're getting 145. So that doesn't give us any sign of a change in trend, other than to think that maybe something's slowing down, but we haven't seen the big cratering so far. Nothing at all. Nothing at all to crater us. Nothing to change its trend. Nothing to do anything. I wish I could give you a better, clearer, happier picture, but these are not giving us anything. Now, what about the bear pause warnings? In terms of bear pause warnings, we had lots of bear pause warnings last month in the top, which was fantastic. We currently have 145 stocks on bear pause warnings and nothing. This is what it looked like last time we did a webinar before I went overseas. We can see here, I was just putting out the warnings. Now, this is what it is now, 145 stocks. Last time we saw Dow on bear pause warnings, E-mini on bear pause warnings, Dow Jones Euro stocks on bear pause warnings, CAC, German DAX, S&P 500 index, S&P value index, and with a bull-bear ratio approaching 10 to 1, it was risking buying to me. Now, on the first decline, we've got so many stocks that are being recommended as being not so good. You've got to think that there's a little bit of changing trend happening. But it isn't. We're not seeing, we're just seeing people slashing their wrists for no good reason, really. I'd like to think the whole world is going to hell in a basket, but let's look at some of the weeklies and look at the technical position. This is the S&P 500 futures index. We can see, yes, it's been slip sliding, and yes, it's below those levels, but it won't take much to resurrect itself above 1985. So I can't get super bared up just yet. I wish I could. Give me, the mouse is not doing the right thing by me. So that's the S&P 500. I want to look at now at its seasonal pattern as well. And you can see here, the seasonal pattern has one moment, I need to find my mouse going slow. It's just actually really going slow. I put in new batteries and maybe it's on its last leg, so I might put in a new one. Let's, come on, mouse. Yeah, in any event, you can see it's a little bit weak, but it hasn't died. Really hasn't died. Let's have a look at the the overall market itself on the S&P 500 cash index and have a look at that. Come on, mouse. Just a second, I need to put a booster in my computer. There's a little software that supposedly boosts the power of it. And so often it is dying. There we go. So that's not giving us a picture of complete disease. We're seeing a dip, but nothing that gives us anything that says this is the end of the world as we know it for the US stock market. I'd love to think that. We do have a difference in the Australian stock market, and I'll canvass that later. But look over here, we're seeing this market, generally it's made a plunge down, but there's still possibilities of higher targets. We're seeing the Dow. Let's have a look at the Dow on the Dow itself. We're looking at here. This still hasn't done enough. This is like a 5-wave structure. We've had an ABC pattern, and if it starts to get above 17,200, you have to switch to being positive. Let's look at some timing factors and think about that. So we've got cycles that are not negative, at least coming up in the next month or so. And so we see the chart here. Trend's still not broken in the S&P 500 cash index, or at least in the futures. We see on the weekly chart coming back into support down at 1950. Now these are my preferred target areas if we get down to them in the S&P. 1890, 1905, 1915. We need to break down through 1960 to confirm those sort of things. Yes, the seasonals do point down into basically the 10th, so there's a couple of weeks up the sleeve, but I don't think you can get super bearish, particularly because Janet Yellen ain't changing her spots. S&P 500 cash index, same deal. It tends to like to bottom around about the 25th of October, a little bit different to the futures. So 1930, nice place. What are we doing here? What are we doing thinking of all this bearishness? So reality, things aren't really collapsing in the US. And where can it come down to in terms of the Dow? Really, the best area we could hope for on a big fall would be 16,345. On a reasonable target, if it does want to continue to slip slide a little bit further, 16,722. Not too deadly. Now let's have a squeeze at the rest of the world, and we'll look at some calculations, and we'll have a look first off. There are some end of trends, and when we look at the various markets we're in, I'll just reel them off for you. The ones that could be most seen as in the end of trends are the German DAX, the Dow Jones Industrial Average, and the NASDAQ, and the S&P 500, and the very own financials index for Australia. Now, in terms of the ones that have ended, we've talked about the Shanghai A shares index, and we have a funny count here, and I want to show you this. The machine thinks that in terms of the global indices, that the Shanghai A-shares index is a possibility for being a fourth wave in a downtrend. And what that means is it's possible that it will continue to, it may be still wanting to go down. We've seen that wave count before. And we see wave 3, 4, 1, 2. Now, 2 is a correction. Notice this says A. Down here is A, B, C. And it's saying here wave 1, 2, 3, 4, 5. And yet this is 2 of 5 and more to go on the downside. So overall, the wave count is still negative unless it gets to 2,559 on the downside. So the Shanghai A-shares index has a cycle which will keep it up until 3 days after the end of Golden Week. After that, it may be for young and old. And the important thing is not getting above 2,559. It may just tag it. If it fails, that would be a reason to start thinking of looking for it lower. Now, my belief is next year is the year to get invested in China, and I've been partial to China, and obviously the Chinese government is trying to manipulate people into buying stock. Alibaba's come up. We might have a look at that later. That might be fun to see. But overall, those are the things that we should be watching out for. I don't know what's going on with this computer. Just forgive me for a second. It's doing some funny things. Anyway, you can see here the German DAX still thinks that it's in a fifth wave, and if I can get this larger, that would be fantastic. I have a frozen computer. Let's pick up the Dow. I want to have a look at the DAX. I want to look at the UK FTSE particularly. And let's pick up the UK FTSE. And apologies for the computer going slow. I can't do a reboot at the moment. And we can see the UK FTSE, again, it's failed so many times at those old tops and it's struggling. So we've been treating this as a range, and it's been quite correct too. It's still 5 waves in structure, like maybe the 5th of the first wave out, who knows, or at least 3rd, 5th of the 3rd. But it's really struggling. So I'll leave the poor English alone. And with higher interest rates, it's not going to work so well. Let's look at the German DAX in a bit more clarity now that we've got the computer working at least. And it wants to revert to being small. Actually, no, this is the German DAX here, I think. No, actually, this is the German DAX. It wants to keep on being small. Let's get out of here, otherwise I'll just get irritated. So again, charting wise, let's go straight to the charts and see where we're at and have a look at some of the cycles going on in the German DAX. The pattern, we've been short the German DAX. You can see tonight it's actually starting to get a little bit more excitement. It's pulled back close to the fib retracement. No, not very close, but a 50% retracement. It's gone a little bit further. So German DAX probably rally up to 9,600, that sort of area on the top side. There's nothing untoward about that. When we look at the German DAX, we see just churning. 84.70 would be a buy if it got down there. That would be the best option. Now let's look at the German DAX's cycles. And let's look on the weekly basis. You can see it tends to bottom. It tends to bottom in early October. And so next week or so, it's a good idea to get rid of our German DAX shorts. And in fact, let's take some profit on the German DAX now. If you just write that down and remind me at the end of the day, we'll take profit right now at 94.68 or wherever it is. And just 94.66. Just bank the cash for 1/2 if you want to keep it running. You can have your stop slightly higher up at, bank the cash on 1/2 and stop can be the same at 96.03. I'm happy to bank the cash on that one. UK FTSE. We can see the UK FTSE has lobbed down close to the area. I was promising around about 65.50 area I thought it could get down to. At the moment, this is not live data. It doesn't update on my script, on my charting package. But 67.36 would be the area to 67.60 you could expect it to go back up to. It's been messy. It's been in a range. It's the bottom end of the range. You can expect it to go back up. Let's look at the cycle tendencies on Europeans. Pick it up. Cyclically, it's end of October, early November that you can expect it to go down to. So don't get too excited about UK FTSE, and you can see that it's spent all of its life living for the past 2 or 3 years, living in this range. What can you do with it? It's the bottom end of the range. You buy it with a tight stop. Now we do talk about the big range volatility play, and we've been liking to buy the VXX, as many of you've seen. It's been a good little thing. For a change, it's been actually rallying like it's interested, like the volatility index itself. We've got a target at 18.53, but you can see that it's top end of the range again. Didn't quite make it. So banking the cash in VXX to the tune of 1/2. We've been long the VXX. We've been long the VXX since, where is it, down here, and we bought some more, but we're going to raise our stop loss up to tonight to $30.28. We've been hoping for $35 or $37.66. I don't see that happening tonight at all. Let's have a look at the E-mini S&P, where it is at the moment. We can see that it's trying to resurrect itself. I would have loved to have seen it down here at 1890, and I just can't see it. Look at the way that it's falling all over itself. It doesn't know what to do. It probably is waiting for somebody to buy it, really. So I think you should be looking at getting your head straight for buying opportunities on end of October, definitely, maybe even maybe even down at maybe even next week or this week. So watch carefully. There's still cheap money around. I wish I could give you a big bad bear look. And John, would you be ready in a little while? Would you be ready in a little while to come on? I think John's just here. See if I can get a hold of him. At the moment, this is a Japanese Nikkei, and we know that it's been manufactured against the US dollar. We can see it likes to have a higher US dollar. US dollar getting close towards 110, which is a fairly big number. You notice that it's been going against its own seasonal cycle. When that happens often, you get a chance for it to end at its seasonal cycle low point, but on a high. So middle of November, you think about that. Okay, so here's my conclusions. We've got to look out for buying reasons at the end of October. That's basically it. Cheap money is sadly with us. So by the end of October, it'll be reasonably simple to think about buying. Higher US interest rates in the long end have tried to come in a little bit. They may get higher. It's the cheap rates that people gravitate to when they're buying. When they raise interest rates, then there will be some problems. The question is, will they ever raise interest rates in the US with a completely socialist president and an extremely socialist, although worth $30 million, Federal Reserve chairman or chairperson? So my conjecture is we've had a bit of fall, but it's not the fall that we wanted. Everybody, that's a bad one. Oh, really? I sent the wrong link. Oh, thanks, Adrian. Well, in fact, I sent it to the wrong people as well, so that should have sort of stuffed them up a little bit anyway. Should have confused them. I did send it the wrong place. What I want to do is I want to have a 5-minute or 8-minute break, and I'll stop showing the screen for a little while. I'll turn it off, and we'll come back at 8:30 and start the Australian part. So go and have a bit of a break. I was expecting to see John in here today, and he's going to have a session, but I haven't got any results back from him. So I'll be back in a little while, and we'll just pause the broadcast a bit and mute me. I'll be tinkering around, and we'll be back at 8:30. Welcome everybody. Apologies for the delay there for those people who've just come in. We were having a break and should be able to see my screen from now. And welcome. And we will run a session on question and answers. Now, this system, I must warn you, has about a 30-second delay on the stocks. And I'm going to ask you a question which is interesting me, and it will be something you may or may not agree with. I'd like your honest opinion here, and I'll reveal it in a little while. You'll get to know. You'll get to see the results of this poll, and I want to know what you think on a couple of things, and it will probably help all of us in a little while. So we'll get on to that. So welcome to the Australian Stock Strategy Update for 2014. Our life is very interesting these days in Australia. We have falling commodity prices. Why do we have falling commodity prices? Well, firstly, there's an oversupply in most places. We've managed to work out that we should be selling iron ore when everybody else is selling it, and we're doing it and increasing the amount of iron ore sales. We do see that the iron ore stock price has become low, which is to be expected, and we've had a few reasons for it going lower. But the Australian market got its normal cycle. In other words, this is a normal cycle where stock markets go down. Remember, the Australian stock market, although it has got low interest rates, it does not have obscenely low interest rates, so it's more likely working normal cycle. What we've seen is that property has sucked interest away from shares. Nobody watches Your Money, Your Call anymore. They're all running off doing courses on how you buy property and how you make money from positive cash flow property, which is a brilliant idea, and somebody should have told these idiots a long time ago that you want to make money from buying property rather than losing money, and you want to have rentals. One of the things, though, that if you have property in New South Wales, is called the land tax thing. And if you buy a property at the end of December, then you pay land tax on the previous year and you pay land tax on the future year as well. The New South Wales government seems to have a double dip. And that can be in the order of a $500,000 property, if you can find a $500,000 property in Sydney, that you would pay as an investor around about $5,000 to $6,000 in land tax on that. It's quite expensive and people don't factor it in. In fact, in Sydney, though, they're actually losing money. Investors are self-managed super funds saying, I hate shares, and then they're pouring and buying property like it was 2007 shares. So, and they're in self-managed super funds. And if you talk to any real estate agent in the eastern suburbs, you'll say, how much are self-managed super people that are buying these units here? And they say 80%. It's not Chinese forcing the prices up. It is people with $500,000, $600,000 worth of self-managed super fund gearing up in property. When they come to retire, these units are not easy to sell. If you really need the money, you've got problems. It might take 4 to 6 weeks to sell at the moment, between the time that you decide and the time that you can actually get it off the books. But in a weak property market, it can take 2, 3, 4 months. So people are exchanging liquid shares in their super funds for lumpy, very difficult to sell property that is losing the money in a lot of senses because the rentals are way lower now, and the rental yields are way lower now, and the prices are higher. So they're borrowing more and they're getting less for their returns, because everybody, when you see a property sold in eastern suburbs, and if it's under $1 million, the first thing that happens is the sold sign goes up, and the next is that for lease goes up. So this is an artificial demand, not necessarily driven by real people wanting to live there, but they're for investments. Anyway, here's some stuff you need to know. It's a warning. This information may contain general financial services advice, which may not be suitable for you because it doesn't take into account any of your financial, personal, objective situations or needs. And you should consider the appropriateness of any advice before acting upon it, and consider seeking professional personal advice. Where this information relates to an acquisition of a particular product, a person should obtain a copy of and consider the product disclosure statement applicable to that product before making any decision. This information is provided by Ideal Financial Group Proprietary Limited, ASIC representative number 299753, and also Aruda Proprietary Limited. It's an authorised representative of Aruda Proprietary Limited, which is AFSL 338674. So we need to announce also that the AFSL licensing will change as of tomorrow. We will have a change in licensing, and we will announce that we'll give you the details on that tomorrow, which you should need to know. So we've seen the American markets. We talked about fall in the American markets, but we haven't seen anything really. The Australian market's been a little bit more complicated. I'm going to start the poll now, and I'd like to know what you think would be the better bank to buy. Is it ANZ, CBA, National Australia Bank, Westpac, Suncorp, or Bank of Queensland? And this is what I normally do, but I would just like to hear what your opinion is of that and why. And I'll do that for a few reasons. Oh. Okay. And let's look at the Australian stock market and the way it's been going. We'll quickly look at some of the cycles. You've seen a lot of this before. The forecast was that we would be expecting to see the best buying in late June, which we saw a good rally, and we expected that to continue. Now, this is based on a monthly forecast, so there are some wiggles and waggles and all those sort of things involved. And the best position for a long trade was long from August to November. We also saw that when we had some timing, the end of June was a good one, and best holding time, July to late October. We had the energy space index as a forecast, looking for a low in late September. Now we see that it's now late September, and we'll look at the energies. The energies had been ignoring the fact that things like crude oil have been going down. They've been ignoring things like, this has been a big decline, and the energy price action has been on WPL. Let's look at WPL. Woodside Petroleum has been going down in the last month, but it ignored it for a hell of a long time. Now, we were looking for a buy down at 40.02 or 40.03 on Woodside Petroleum. Hopefully we'll get another chance. We also saw things like natural gas going down. It started to turn up. So the Aussie stocks have done okay. In fact, natural gas got to its 417 target. That was the target we're looking for. It got to a high of 416 and 2/10 or 0.2, and it's backing off a little bit up today. I don't know what's going on there, but the energy space has now corrected its stupidity from being too high while its own prices, producer prices, were going down. So energy space is a little bit of interest. Notice this, it's completely gone down here, but look at where it's at now. It's down into basically the old tops where it broke up from before. So it's back into some support that we could think about buying. Notice this is a megaphone pattern, and notice there's an unmet target, 15,572. If the US gets control of energy prices, what that means is energy prices go up. The Americans don't like cheap energy for anybody else but themselves. Now I'm going to finish that poll right now and see where we're at. We had a result of 20% said ANZ, 20% said CBA, 33% said National Australia Bank, 20% said Westpac, 7% said Suncorp, and 0% said Bank of Queensland. Now, National Australia Bank has been one of my preferred indices and preferred bank, in that I thought that it wasn't going to fall much. Let's have a look at National Australia Bank. And we can see that it's down the bottom end of the range. And yes, for that reason, I think that it is worth having a go with stock below $31.60 if you are thinking of buying a bank. It is the worst bank in Australia, but it has been the best performing bank over the last couple of weeks. The next one, in terms of preference, came equal, Westpac, CBA, and ANZ. And when we look at CBA, it's now back into, we did think it could get down to $72, but the best area would be $68. If you can get a hold of CBA down at $68 with a stop below $67.30, it's worthwhile looking for an attempt at new highs. There was support here at $72 to $72.50. That still may come in, but notice that the trend is stopped on the monthly. The uptrend has stopped on the monthly, so we should expect a correction either to $68. If that fails, expect $61 to $62. So CBA, I don't think is going to be a complete disaster. It's not. It's certainly not happy. We can see all this volume going into it. I think you can think about some CBA. Now it's had such bad press. Notice it is trending, but to the downside. But notice there's all this support over here, $72, all that sort of stuff, and it's failed to close below this $75 on a weekly basis. So close below $75, not a good sign. But otherwise, I think you can have sniffs of CBA. If you did get out at the top when I'm saying not to buy it, I think you're seeing it coming to the end and could rally back up to about $78.98. The other banks equally likable on behalf of attendees in the audience here. ANZ, that's a nice bit of volume reversal, looking for $32. Now we bought some, we increased our self-managed super fund allocation to equities yesterday, and I think that seems to have been an okay decision so far. Let's look at Westpac. Westpac is like National Australia Bank, not as bad as CBA, it's not as bad as ANZ, so it's preferable to it. But we could spend more time churning, $31, something like that. Pick it up again, $31 to $30.50. pick it up again. You can see the volume here. So if you need to get out of jail card and you want to get out of, say, Westpac, and you've had too much, you'd see if it can get towards $33 and not break through it. If it can get above there, then you start to look pretty good buying it. Notice the volume here. So I have to say, Westpac, number one. CBA, not quite the right level, but just because it's CBA and it's had the kick shooting out of it, that you should have a go at it if you want to come in as an investor, because it's, after all, it is CBA and it's got some good things. Westpac, NAB, preferable, but CBA, if you lighten your load and put CBA up and you're an investor and you want to get some exposure, I think it's okay. ANZ, I'm not so happy with particularly. I think Westpac's the pick of the crop. Notice there's a 5-wave structure to the downside. This could simply be A, B, C. So ANZ would become a better prospect, in my opinion, above $32.50. Does anyone have any commentary on what I've just said there? Any questions? Let me know if you do, and I'll move on. So let's have a squeeze at the financials themselves, because this has been the market that has driven them. Now, we notice here a 5-wave structure to the downside. I have been targeting 58.17 for the Profit Hunter Group members. We see 1, 2, 3, 4, 5. This was the reason I was telling people to buy yesterday. Now, we may have felt a bit stupid, but I think we're in that zone where a break above 59.50 sets interest in the banks for a rally towards 61.58. In the longer term, I'm a little bit concerned about this 5-wave structure to the downside. It does make sense, though, to getting some exposure to the banks for a rally. Something's, I've got a fixed urgency that's come across. So what are we seeing on screen? We're seeing nothing, are we? Got it. Okay.